Hello everyone, welcome back. I got some really good ones for you today. But first, I hope you had an awesome week and you have an awesome weekend. Got a big week coming up next week, so we'll talk about that. But first, let's talk about the markets. The three major stock indices today kind of coughed up some of their gains. They're still up positive on the week. I think what we saw today was traders kind of booking profits on any of those scalps or swings they've made in the last week or so, maybe booking some profits going into next week. There's a lot of uncertainty potentially next week, given that we have major tech earnings, Fed Day on Wednesday, GDP on Thursday. Next week's pretty jam-packed, so anticipating some volatility there. I would say all risk assets kind of pulled back today. Oil pulling back a little bit, Bitcoin pulling back from 24 to 22, gold and silver pulling back a little bit, equities pulling back a little bit. So you just kind of have those risk assets taking a breather, which is weird though, because even the 10-year yield came down quite a bit and the dollar today. Normally, hey, mechanically, that's kind of an inverse relationship. Normally when you see in this environment yields going down and the dollar going down, that leads you to believe generally money is leaving the dollar in those more conservative investments in fixed income and going into risk. So really weird that risk sold off and the dollar, and yeah, people are buying bonds here and driving bond yields down, but that's so weird. Probably the Federal Reserve doing it, but again, even if the Fed is buying bonds driving yields down, you'd think the market would take that information and go, okay, if the debt market is going to be stable, yields and rates are going to be lower, the dollar's going to be lower, inflation's going to be worse, let's get some money into these risk assets and see them go up. Didn't see that today, but again, it's probably just profit taking going into next week. Three major indices are still up on the week, Bitcoin up a little bit, so there you have it. Apple, Microsoft earnings next week, that's going to be big. I would say Fed Day on Wednesday, though, is going to take precedence. Markets are expecting a 75 to 100 basis point hike next week on Wednesday. Even if the Fed comes in at 100 basis points, I actually think that that's still going to be fine for the markets. I even think the markets might flip that to a positive. Generally, when the Fed goes more hawkish and more aggressive in interest rate hikes, the markets don't like that. But the markets have baked in a lot of hawkishness from the Fed, and the market is even telegraphed, dude, we want to see you get aggressive on raising interest rates just so we can at least think in our minds you're doing something about inflation. And then once the Fed goes heavy next week, so 75 or 100 basis points, my prediction, Fed takes some of these future rate hikes like for fall and next year off the table. That allows risk assets room to move higher, dollar lower, keep those mortgage rates low-ish, not in the 7%, but just kind of maybe in the 4s, 5s, maybe 6s, just to kind of keep real estate out of the danger zone, right? Because if rates and yields skyrocket and the dollar skyrockets and mortgage rates skyrocket, it makes home price tags fall because it prices a lot of potential buyers out of the market when those mortgage rates are higher. So again, normally you do see a very inverse relationship between yields, rates, the dollar, and then risk assets. But today we did, see the dollar come down, bond yields come down, and risk assets come down. So kind of a weird day, but hey, it happens. I'm still bullish. NASDAQ, oil, gold, Bitcoin, nothing's really changed there. I really think Fed taking some rate hikes off the table after next week will be very bullish for the markets, very bearish for the dollar, create more inflation potentially, but we've talked about it. The Fed, if forced to fight inflation or save the beast system and protect the stock market, they're going to save the stock market and protect it. So I think the market's going to react favorably to the Fed Day next week, regardless of if it's a 75 or 100 basis point hike. The market really wants to just get this over with and has been baking it in. So we could see a situation where the Fed even comes in at 100 and the markets still rally. Or we could see a situation where earnings are really, really, really strong in high growth tech. The Fed only raises 75 basis points and then maybe the market starts to price in even more aggressive further rate hikes later and doesn't even like that. So I could see weird scenarios playing out either way, just based on what the market is looking for and what it's ultimately going to end up getting. The Fed's two biggest tools right now are managing expectations and then the actual bond purchases or bond tapering. So the managing expectations part is just the Fed saying, look, we're going to be really aggressive. Look, we're going to be really aggressive. I mean, the Fed has talked risk assets out of bed this last 6 months and has had to do very little in terms of actually raising interest rates to make markets cough up a lot. I mean, look, we're at, by the end of next week, we'll be at like a 2.25% Fed funds rate against the backdrop of 14% inflation. Real interest rates are still negative 12% with that back of the envelope math somewhere in there. So, for all this hawkish rhetoric, Fed hasn't really even needed to follow through too much with aggressive rate hikes, and we've still seen the markets fall out of bed. So the Fed does do that. So if the Fed is managing expectations and they're telling you all year, we're going to hike, we're going to hike, we're going to hike, we're going to hike, and it's going to be more than you think, and right when you think we're going to stop, we're going to hike again, and we're going to defeat inflation. It's going to be awesome. The more the Fed says that, if they just tone that rhetoric down next week, like, okay, all right, we've hiked a lot. We just did a 1%. That was really aggressive. We're really proud of ourselves. That was Volcker-worthy stuff right there. We don't really need a rate hike for a while, especially if the economy is starting to slow down. Hey, that leaves rooms for risk assets to go higher. That's just kind of what I see playing out. Part of me hopes I'm wrong, okay? I would like to see the Fed raise interest rates so aggressively they get the federal funds rate above the inflation rate, create a debt detox, cull all these zombie companies that require low interest rates just merely to exist, and bring positive value to the dollar again. Like, I would like to see that, but I know who we're sitting at the table with. I know kind of how these policymakers roll because I've been watching them with a pretty fine degree of granularity for like well over a decade. I mean, the Fed watching is just something that I do almost for fun. So I feel like these people are going to come aggressive next week, 75, 100 basis point hike, and then tone down the rhetoric. We'll still see rate hikes going into the year, all right, but maybe they're only 25 basis points, right? Maybe they're only 50 basis point hikes where the market would have otherwise expected a 75. And so anytime the market has an expectation for a very hawkish increase in rates, and then the Fed can kind of under-deliver on how aggressive they were going to be, that just leaves room for those markets to go higher, right? So I think that's kind of the game they're playing with everywhere. And it puts it kind of puts us somewhere between a massive deflation and Great Depression and a hyperinflation, right? And you're like, wow, the Fed's just going to send us either right into hyperinflation or right into a Great Depression. It sounds like it's all on them. It is. That's why the Fed's not behind the curve. Fed is the curve, okay? It's disgusting. It's anti-free market. The other thing is when the Fed adjust their interest rate, it's not like it's a dial and they just turn it. If the Fed wants to drive rates down, they have to get in and they have to buy bonds and drive those yields down. The Fed can't just sit back and turn it like a dial willy-nilly and just say, oh, interest rates are here, haha, and not expect that to send massive reverberations out through the economy. And so the Fed has to act in the market, has to get into the market and essentially crowd out the private sector and make that market less free in order to get the results they're looking for and push their agenda. But when other players at the table see the Fed getting in there, underwriting the global economy, pinning rates and yields way lower than they should be, buying bonds, they see the Fed talking about rolling off its balance sheet, which theoretically is good for the dollar, but then watch the Fed not meaningfully roll off its balance sheet. I mean, it's right there for you to see. So the Fed uses their expectations. That's probably been their number one blunt tool. And then they, back that up with actual policy. But that departure too between what the Fed says they're going to do and what they actually do, that difference is really been hurting the Fed's credibility. So every time the Fed plays these little games with everybody about what they're going to do with the interest rate and how that's ultimately going to set the price of every asset you can think of, it starts to markets really don't know how to behave, and they start just to be Fed dependent. I'm sure 30 years ago, Fed Day wasn't that big of a deal. Like, I'm pretty sure there have been times in market history where Fed policy didn't take the forefront of every discussion. The world we live in now totally takes the forefront of every discussion, and that, my friends, is not by accident. So, if you want to get harsh with the terminology, I would, and I did call it out in 2020, it's a bit of a fascist takeover. In 2020, the Fed was already behind the curve in raising interest rates because they were supposed to do it back in 2015, 7 years after the '08 crisis. They decided, let's just pump equities and real estate instead. I mean, they even got Trump to go out there and advocate for negative rates. But again, I'm not saying the Republicans are more guilty here than the Democrats. It's big government, big government, big government, low rates, low rates, low rates, no matter which side of the aisle you get. It is funny though, in 2016, I actually became very excited and showed a lot of support for Trump when he went on the debate stage against Hillary. I'll never forget it. And he said, the Fed's being political with interest rates. If you raise interest rates even a tiny bit, the whole thing comes crashing down. And I was like, this guy actually understands the interest rate trap that the Fed's getting us into. But, I interpret that as, so once he gets in, he's going to raise interest rates, address these issues, keep the Fed from being so political. But what really happened, he got in, he stopped talking about interest rates. They stayed way too low for way too long through his 4-year term. And then when we're at a point where we're at the crossroads of a recession, staring down the barrel of this pandemic, we were supposed to be in a position to start cutting interest rates. And ultimately we did anyway, but with way more ammunition. We needed to be cutting rates from the 7% Fed funds rate, not a 1% Fed funds rate. It means the stimulation, that rate cut from 7 to 0 would actually stimulate the economy, get things moving again, bail the economy out, and keep things going. When you go into a recession and you cut interest rates just from 1%, 1.25% on the Fed funds rate down to 0 real quick, that wasn't a lot of stimulation. That was 100 basis points of stimulation, 125 basis points of that's not really enough. So then you get stuck at 0, and then you just got to print trillions of dollars and stay stuck at 0 and just print trillions of dollars indefinitely just to remain where you are, never mind additional growth and productivity. And you've been living that. So that's why the Fed's dragging its heels on interest rates, because they are getting multiple credit cycles behind this game making any sense with their interest rates. You're supposed to be at 0 on the Fed funds rate during a recession. As you come out of the recession, raise that Fed funds rate back to 7.5%, 8%. Have another recession, cut from 7.5%, 8% back down to 0. Rinse and repeat. The Fed has gone from 0 in 2008. In 2015, they were supposed to raise back to 7%, 8%. They decided we'll just hang out around 0. Next thing you know, it's 2020. They're still hanging around at 0. Next thing you know, we go into a recession. They had never raised up to 7%, 8% on the Fed funds rate in order to cut again and effectively stave off that recession. So they had to cut from 1.25% down to 0, stay there indefinitely. That was the Fed saying we're not even thinking about raising interest rates back in 2020, and just print the money, add 40% to the money supply. So the Fed really needs to break the back of inflation. They need to go medieval on inflation. And the way you do that is you raise your interest rate, the federal funds rate, above the inflation rate. So we're talking 16, 17% on the Fed funds rate. That would put mortgages 18, 19%. That would break the back of inflation, cause the dollar have positive value, push people into cash, cull the zombie portfolios, debt detox. That would be your deflation that you want. I'm sure some of you want so badly. And if you're gonna have a free market, you would look for that, right? If I thought we had a free market and with flexible prices, put it this way: if the Fed wasn't allowed to set interest rates by buying bonds or selling bonds, and the free market just started to let interest rates set themselves on their own, the first thing I think would happen is the 40-year bond bubble, the US debt bubble in the bond market, would implode. 10-year yield would skyrocket, bond yields would skyrocket, the dollar would skyrocket, interest rates would skyrocket, and all these risk assets that I've been so bullish on for the last month and a half, like the NASDAQ, gold, Bitcoin, oil, they would all crash by 80%, 60%, something like that. And that would be your great deflation debt detox that so many of you fair market people are just like wondering when's going to happen. But I'm here to tell you, you don't have a free market. So Fed's going to manage expectations. Fed's going to do whatever they want with interest rates. Fed's going to be the curve. And the reason for that too, you might be like, well, the Fed can't be that obsessed with being a serial bubble blower. Well, I mean, they like serial bubble blowing because it makes them rich and they don't hold dollars, but that's not even the real reason. The pensions, the 401ks, the Ponzi's, all these institutions, Social Security, it all has an embedded growth obligation, okay? They need 6 to 12% per year in the equity markets 8 out of 10 years. And if they don't get that, like we don't have the growth to support that, well, they're just going to print that difference, okay? And they're going to make themselves have it. And you're like, well, there's no free lunch. Of course there's not a free lunch. It destroys the middle class. It's why the middle class is going away. That's why I'm not freaked out about deflation. All these people are like, oh, I like to hide under a rock and wonder when the next crash is going to happen. As these markets go up, that is the crash. Your future self is getting so poor. How many shares of Tesla are you going to be able to buy in another 5 years? How many Bitcoins are you going to be able to buy in another 5 years? How many houses are you going to be able to buy over the next 5 years? Those things are getting pretty expensive, and that is not by accident. So Fed is managing the markets. It's disgusting. I get it. But I also don't want to come out here and just have a freaking meltdown or, just be too much of a shit talker. So I'm trying to keep it together and just keep a level head and just objectively talk about prices, where we're at, where the policymakers are at, and what I think they'll be doing. So, wow, we talked about a lot. Next week, keep an eye out on Thursday for that GDP number. We had negative 1.6% growth in the first quarter. If that number is negative again, you're officially in a recession. CNBC is going to say it. Apple News is going to say it. Official recession. But I think asset prices will go up if that happens, because the market, I think, is pretty well priced in a recession and 2 quarters of negative growth. And even if the markets aren't ready for a negative GDP print for Thursday and they initially freak out and deflate real fast from that uncertainty, what's to keep the Fed from stepping in, taking interest rate hikes off the table, reinflating their balance sheet, driving yields and bond yields and interest rates and the dollar down, and just inflating everything. That's why it's so hard to be a deflationista, because you need a free market for that to be possible. It's kind of a dark one, but hey, we're going to be okay. Stay strong. Knowledge is power. Information is the currency, right? It really is. Information's the real currency. And that's just my thoughts. Leave a comment, like, subscribe, whatever. Really glad you could stop by. And I hope you have an awesome weekend, and I'll be with you for next week, all right? Next week's going to be a pretty crazy week. Till next time.